Cathie Wood is excellent at picking the right stock to grow her investments. She founded ARK Invest, a firm with close to $60 billion in assets. She is known to be a modernist by investing in the technology of the new era, such as driving cars and genomics. She had heartache in 2022 when her fund fell significantly, dropping 70%. Although this fall has been made up for, things are looking up. There is a 40-minute video of Cathie Wood that makes us understand why there is trouble brewing in the U.S. economy. So we will be saving a lot of your time by bringing you the main points she talks about in her video. After all, why would an investor who trades make hay when the economy is shining? But Cathie predicts that a cloudy period is ahead and may even lead to a storm. Wood secured a position as an assistant economist at Capital Group in 1977 through her mentor Arthur Laffer, where she worked for 3 years. She relocated to New York City in 1980 to start working at Jennison Associates as managing director, chief economist, analyst, and portfolio manager. She spent 18 years there at that job. She engaged Henry Kaufman in discussing why she thought interest rates had risen in the early 1980s. Wood co-founded Tupelo Capital Management, a New York City-based hedge fund, in 1998 with Lulu C. Wong. She worked for 12 years and oversaw $5 billion as Chief Investment Officer of Global Theme Strategies at AllianceBernstein, where she joined in 2001. However, she received criticism for underperforming in the market as a whole during the economic meltdown of 2007 to 2008. As a result, 2014 saw Wood leave AllianceBernstein and launch ARK Invest. However, after her active management, the exchange-traded funds concept based on technological technology was rejected by the brokerage firm as being too risky. Wood studied the one-year Bible when the company was christened after the Ark of the Covenant. Bill Wong of Archegos Capital provided the first funding for the first 4 ETFs offered by ARK. Editor-in-Chief Emeritus Matthew A. Winkler of Bloomberg News selected Wood as the top stock picker of 2020. Wood's flagship fund, ARK Innovation, has lagged behind the S&P 500 for the previous 5 years as of May 2022. Since its peak last year, the fund's value has decreased by more than 70%. The GDP has now fallen almost 1% in consecutive financial quarters. The government is trying to control the fall, but there seems to be no respite in the economy. The market is in a strange flux as many indicators, such as unemployment rates, seem to be dropping, and quite a few stocks are doing fine. So it seems all sunshine, and not a cloudy outlook on the future. Yet there is a storm brewing underneath all of this seeming recovery. Everyone who knows something about the economy knows it is facing a fuel crisis due to the ongoing Russia and Ukraine conflict. The real estate bubble in Southeast Asia adds to the problems. The U.S. is the final piece in the trinity of financial headaches. Inflation has caused the rates to rise at an alarming level, making it difficult for investors. The market has turned into a bear that may initially lull investors into thinking everything is fine. Still, then a deep plunge rocks the investors. In fact, this was the scenario that played out during the Great Economic Depression in the U.S., where the market rose close to 48% after an initial drop. Then the massive drop came from an 88% plunge in stock prices. What followed was that prices were unable to recover for the next 25 years. These rallies are typical in a market that is increasingly becoming a bear market. Cathie Wood also reiterates that this could be the case with the slight recovery we are seeing now in the markets. She gives forth 3 main points that show that the economy will suffer a little more in the coming few months. The first factors are the consumers that provide one side of the growth coin: demand. The problem here is the bigger retail chains in the country are suffering due to the lack of demand in the economy. This means that the demand outlook by these chains has not materialized. Therefore, they are sitting on many inventories they cannot sell. This problem seems to have no end, and the stock of products unsold is causing massive losses to these chains. It is not like these chains have not tried to incentivize their sales. However, the consumers are obviously not in the mood or position to spend the money on these purchases. Wood speaks on the same where she mentions that these giant retail chains have attempted to stock up their inventories. Yet, the consumers have shut shop and are not spending their money. Hence, even if the GDP goes into positive growth, the inventories will pull the GDP back. In addition, a survey conducted in Michigan proved that consumer sentiment is at a low compared to the same metric in the 2008 crisis. Another point here that Cathie Wood makes is that there is stagnation in the housing market. The U.S. housing market contributes around 15 to 18% to the GDP, so it does buy residential investment and consumption spending on housing services. On average, residential investment accounts for 3 to 5% of GDP, including building new single and multifamily homes, remodeling existing homes, manufacturing manufactured homes, and broker fees. Consumption spending on accommodation is around 12 to 13% of GDP on average, including gross rent and utility payments made by tenants and imputed rent and utility payments made by owners. Now reports are coming that a substantial reduction in sales and prices of prime real estate is dropping in the market. This may lead to a slowdown in the contribution made by the housing sector to the U.S. GDP. She points out that Robert G. Shiller has predicted there is going to be a 10% fall in the prices of homes in the country. American economist Robert James Shiller is a best-selling author, scholar, and 2013 Nobel laureate. In an article published in 1981, Shiller argued against the efficient market hypothesis, which was the prevailing theory in economics at the time. According to Shiller, rational stock market participants base stock prices on the discounted present value of expected future dividend payments. He looked at how the American stock market has performed since the 1920s. He thinks that the kinds of discount rates and dividend expectations might be used to explain the stock market's wide range of variations. Shiller concluded that there was no plausible explanation for the stock market's extreme volatility. Therefore, Shiller has a history of analyzing these challenging economic times. Robert Shiller has previously correctly predicted stock market and housing bubbles. He has warned that the housing boom sparked by the coronavirus outbreak may be headed for a fall. Shiller noted several indicators of the possibility of a recession in his interview with Yahoo Finance. He included the ongoing pandemic, resurgent inflation fears, and mistrust of what the Federal Reserve will do with interest rates. He declared that we have many components that could trigger a recession. According to Shiller, home values have increased by almost 40% nationwide over the previous 2 years, continuing a trend that began during the crisis of 2007 to 2009. He believes that right now, things appear to be almost as dreadful. While property prices increased by nearly 20% year in May, the Home Market Index, composed of the National Association of Home Builders statistics on traffic from potential purchasers, has fallen off a cliff in just a few months. The conversation has become very negative. Sales of existing homes are down and permits are down, so there are numerous indications that something will occur. It might not be fatal, but it's essential to consider it. A yield curve represents the yields that interest rates of bonds with similar credit ratings but various maturities. The yield curve's slope provides insight into potential future changes in interest rates and economic activity. So when this curve achieves a negative point, it can indicate an upcoming period of inflation. If you look at the curve in recent months, you can observe that this fall below the mark zero has been even further, causing a lot of worries. This is a warning sign that must not go unheeded. Even Cathie Wood has agreed on the same. Therefore, her predictions are a lot more bearish, as she believes that the yield curve falling down is a telltale sign that we are in a recession. In addition, she points out how the interest rates are down almost 70 points, currently at 2.83%. On the other hand, 2 years-long short-term Treasury bills have moved up in the lockstep at 3.24%. Cathie Wood further talks about the inverted yield curve to 41 basis points. All of this points to the fixed income markets, which are letting the Federal Reserve know that there is trouble coming and things are not going back to normal just yet. Either the economy might crash, or else the inflation will keep rising. She suggests that there is a possibility that there will be a threat of both opportunities coming into reality. There may be more ugly surprises coming our way regarding the inflation growth. Let us know your opinion in the comments. With that, we've come to an end. See you next time. Goodbye.